Welcome to the Pursuit of Progress podcast, where it is all about chasing that 1% improvement every single day. This podcast is here to ignite your passion for continuous learning and growth. Each week, we dive into fresh conversations and actionable ideas to help you elevate your mindset, sharpen your skills, and transform your life. If you're obsessed with getting better and living with purpose, then you are in the right place. Now let's get after it.
All right, and today we're going to ask the tough real estate question: is home ownership in 2024 really worth it?
I like it. That's a comment that is being heard around the world a lot right now. So it's a good timing for this episode, Ben. And just kind of going right into this, is home ownership really easy to achieve in 2024? What are your thoughts?
Yeah, well, listen to this. I found this article online. It was based off of a recent Wall Street Journal survey that was done in the month of July. And listen to the headline and then a couple talking points from the article. So 10% in new survey say homeownership is easy to achieve. And then listen to the article here. Just 10% of Americans in a new survey say homeownership is easy to achieve, even as 89% see owning a home as essential or important to their vision of the future. According to the Wall Street Journal poll taken in July, U.S. adults have a difference between their wishes and their expectations on various long-term economic issues. Financial security and comfortable retirement also ranked as important but difficult to achieve. The outlet noted that 12 years ago, the Public Religion Research Institute asked people if the American dream still holds true. More than half said it did. Today, according to the recent survey, just about a third of the respondents say the American dream is achievable. Economists say people are right to feel that way, the journal said, even as younger generations have been priced out of homeownership and struggle with student debt. So reading that, what I'm picking up on is everyone is acknowledging 89% how important homeownership is, but 90% are saying that it's very difficult. Only 10% are saying that it's achievable currently.
It's crazy, man. Definitely a difference between what people want versus what they need or they feel like they can achieve. That's crazy. So let's just kind of dive into this first question that comes to mind on my end is just, why is that? Like, why are so many people pessimistic at the moment? What is the reasoning behind that? And I guess more importantly, how can that be improved in your mind?
Yeah, being a mortgage banker, I'm in front of this every single day. I mean, this is what my full-time job is. So really no one knows this stuff better than me. And in 2024, unlike just a couple of years ago, these are some of the issues that we're facing right now. Property values are at an all-time high. They haven't gone up over the last 12 to 18 months like they were during the pandemic, but they're still at all-time highs. Property taxes, this is something that a lot of people aren't talking about, but a lot of property taxes are at all-time highs with their counties or their states. Here in Denver, Colorado, we repealed a property tax kind of protective. It was a law that protected homeowners and put a lot of the burden for property taxes on businesses instead of residential owners. Well, that was repealed here in Colorado. It was called the Gallagher Act 4 or 5 years ago. And as a result, guess what? Property taxes have skyrocketed and they're at all-time highs. This is something else that's happening right now that is a little bit of a crisis, and it's the insurance, homeowners insurance, and the entire industry is going through a huge period of flux right now. And a lot of homeowners insurance policies, not only are deductibles changing, but premiums are going up and up and up. And from what I'm seeing, working with customers and prospective home buyers, I'm seeing the same things. It used to be common to have, for a primary residence, have homeowners insurance of $2,000 or less. And now, it's not uncommon to see policies that are $3,000, $4,000 or more. And then this is the other thing that's a really big factor, is that interest rates are at a 20-year high. At least they were recently. We've gotten a little bit of relief here in the last 4 to 5 weeks, but for a big part of this year, property taxes at an all-time high. Homeowners insurance has been going up. home values are at an all-time high, and interest rates are at a 20-year high. All of that together spells affordability crisis.
Mm-hmm. Yeah, all four of those have a lot to unpack. Just talking a little bit about the property taxes and that Gallagher Act you're talking about, is that also part of the thing that happened where you can only get a new appraisal done every 2 years instead of every year? And there's like some changes with that stuff too. Is that part of the Gallagher Act, or is that something different?
What that is in reference to is because assessments have gone up so much, every county has an assessment that they provide the homeowner with. Now, the homeowner has the right to appeal the assessment if they feel that it's out of range or it's too high. In the property tax world, your property taxes are based off of the assessment from the county. Now, that's different than what the market value of the property is as determined by an independent real estate appraiser. A lot of times homeowners get those confused. Now you have the ability to rebut or repeal the assessment once you get it in the mail. Usually the window to do that is 30 to 45 days. So you do have to act quick. Most places though, you can, rebut it online, or you can do it in person. And this past spring, for one of my properties here in the Denver area, I did file an appeal and I won. They actually reduced the assessed value, based off of my argument. So I was able to use that to get my assessed value down, which then lowered my property taxes. But is it life changing? No. It may have taken $200 or $300 off of a property tax bill that was up 250% over the last 7 years. So still
Mhm.
a substantial increase when you look at the last 5 to 10 years.
Yeah, I've been just using the rule of thumb when it comes to property taxes, just for people to maybe keep this in the back of their mind too. If you're in an area that's fairly developed, it's not, a brand new area that has a lot of roads and just civil engineering still going on. If it's an area that's a little bit more mature, similar to probably
Mhm.
where, both you and I live currently, 0.5 or 0.6 of 1%, so about a half a percent of whatever home you're looking at purchasing, that's kind of a good ballpark for what the property taxes are going to be. And then if it's in an area like a
Mhm.
new construction area or an area that just has some additional, stuff still going on, that could be as much as 1%, or even as high as 1.5% in a few places around towns. Just kind of that half a percent and 1% are good, just ballpark percentages to keep in the back of your guys' minds.
Yeah. So if you have a home that's priced at 800,000, I think what you're saying is that, if the home's priced at 800,000, you should expect property taxes that are around 4,000, or a half of percent of what the
Correct.
market value for the home is. And kind of to your point there a minute ago, if you are looking at something like new construction, and there's been several Denver Post articles on this, just over the last 12 months, because this is a crisis with some of these newer construction developments on properties that are recently constructed. They're in metro districts. And so as these properties are built out, the property taxes are a lot higher because it includes a lot more under the tax bill for the entire community. Some of the roads, the education, the parks. And the problem with that, though, is that you'll have a home that is priced at 700,000, but the property taxes are like 12 or 13,000 annually, and so you have a tax bill that is so out of whack as far as what the home cost, that it is so restrictive and prohibitive from buyers that would normally be able to afford that. It just makes the buyer pool so much smaller, and then for the existing buyers, it makes it very, very unaffordable. So those are also things that you really want to be aware of.
And then the other thing that just piqued my interest when you're going through a few of those statistics on the homeowners insurance, I've also been hearing about some of these pretty large companies that are just totally pulling out of certain states. I know a lot of big companies have totally left California, but I've also heard even Colorado is going to start seeing more of that when it comes to just these insurance companies worrying about fires and just some of these other insurance claims that have really been picking up over the last few years in Colorado. So you won't be surprised if you see Progressive or some of these even big name companies no longer providing insurance in
Mhm.
Colorado. So kind of crazy.
Yeah, it's so interesting because when you think about some of these natural disasters, whether it's a fire or hailstorm, the frequency with a lot of these things just seems to be picking up, not just in Colorado, but really all across the country. You think of some of the fires in Maui this past year, where thousands of residential units were burned down. And then there in Colorado, we've had, fire problems of our own. We're also a really big state that gets impacted by hail. I've been in my home for about 9 years here in the Golden area. I'm on my third roof in 9 years. And so the frequency and the intensity of some of this stuff is just really, really picking up.
Yep, I'm waiting on
And
State
then that, and
Farm
then, and
to.
then, that's what's impacting premiums and, some of these other policy concerns.
Mm-hmm. Yep, I'm getting a new roof and windows from State Farm as we speak, and just pretty much every home on my block is doing the same. So it is pretty crazy just how much money is, you know, accounted for with these claims. I think I told you a few weeks ago, just to
Mhm.
get new windows and a roof in my house, the claim was pushing $180,000, which is just crazy. So
I mean, think about
Right.
that. And
I know.
and think about if you had to pay for that out of pocket. I mean, it's just an outrageous amount.
So let's just talk a little bit more about just home ownership. I think you have some statistics here that I'm looking at with our notes about April 2020. So basically, a little over 4 years ago, what the home ownership, kind of some of the statistics were then versus now.
It's funny because doesn't it just seem like yesterday that home buyers were literally lining up to buy homes and go to open houses? I remember an open house specifically that I went to in 2020 here in Jefferson County, Colorado. When I got to the open house with the real estate agent to go inside, there was a line of about 40 people lined up outside. I mean, that's how crazy it was. And so here's why. So going back to and this data here is from April 2020. The median home price in April of 2020, so kind of right during COVID, was 250,000. And this is why so many are pessimistic about affordability and homeownership is because of these numbers. So listen to this data here from just 4 years ago compared to where we're at now. So $250,000 median home price from April of 2020. Your average interest rate was 3.375%. Your monthly payment with 10% down would have been $994 a month. That's principal and interest. With 20% down, your monthly payment would have been $884 a month, principal and interest. And that's 4 years ago. Now, do you want to hear what the data is as of 2024?
And this one quick side note, guys, this is national, not specific to Colorado. Yeah, let's hear 2024.
So 2024, the national median home price is 410,000 as of, and this is as of May, so a couple months ago. The average interest rate at that time was 7%. So if you were going to put 10% down, your average principal and interest payment would have been $2,454 with 10% down, and then $2,182 a month with 20% down. So you can see the outrageous, price difference in monthly cost and affordability from just 2020 to 2024. We're talking 4 years. That's a 147% increase in housing expense from 2020 to 2024. And this is also another interesting stat that I want to share. So to comfortably afford a home in 2020, based off of average home price, interest rates, etc., you would have need to have a salary of around 45,000 to comfortably afford a home. In 2024, you need to earn 93,000 to comfortably afford a home. So in just 4 years, you have to almost double your income to afford the same home.
Yet I know just from being in the corporate world back in the day, or just hearing, some other friends of mine that are in that world today talk about, how much you should ask like for a raise every year. And I think, the average is like between 2 and 3% a year is kind of like the norm, or what's kind of acceptable and expected. So you think of 2% a
Mhm.
year, maybe if it's even 2.5%, that's, 10% over a 4-year period. Yet you really need to have like you said, 200. So it's 100% higher than more than 100% higher than it was 4 years ago. So, yeah, there's no way that that's going to work for many people.
Yeah, and that's not even factoring in some of the other increased costs that we just talked about. The increased property taxes. That's principal and interest payment only. So that doesn't include, the inflated property taxes and the homeowner's insurance. Same thing with condos. HOA monthly fees, annual fees are also increasing for all of the same reasons. So that's just principal and interest. It doesn't include those other costs. And once you factor those in, that number and that percentage is going to be even higher.
Yeah, just the numbers you shared a minute ago, just with the 10% and 20% down scenarios. Again, 10% down, we'll use that for the example again here. In 2020, with 10% down, just under $1,000 a month, $994. In today's current status with the same exact, scenario, 2,454 a month. So, I mean, that's crazy. I mean, it's very clear again why the answer to this pretty simple question, I guess, as far as why do so many people feel this way right now. And I guess going from there now into the other part of this question, just how can this be improved? What's your kind of sentiment on that part of this?
Yeah, and this is something that I've been saying for years and years. There was a sentiment when it came to financial planning, personal finance, hitting some of your financial goals. There was really a sentiment over the last 50 years in the United States where, you would go to school, graduate from high school, go to college, get a good job, buy a home, and start planning for retirement. And along the way, you didn't need to always be super disciplined, super intentional. You didn't necessarily need to invest, in retirement accounts. You were probably going to get a pension. There was probably going to be some other benefits. People back then, they didn't change jobs. They found an employer and they stayed there and worked there, through retirement. So they got a pension. All of that is out the window in 2024 because things have changed so much. When you look at the rate of wage growth as it relates to costs of housing, costs of living, costs of just supporting yourself, costs have substantially outpaced wage growth. Inflation is a concern. The value of the dollar has been going down relative to what everyone is earning. For someone to own a home 50 years ago, the percentage of that payment compared to their income was much less, what it is right now. So the point that I'm making is that all of us in 2024 and moving forward need to be very, very intentional with our planning and really play the long game. You have to be intentional if you're going to go to school. You can't just go to school and get any degree because 30 years ago, that was okay. The only thing that mattered was a college degree, and college was so affordable, it didn't even matter.
Mm-hmm.
Now, though, the percentage of degrees that will actually pay for themselves is so small. So if you are going to go to college, you have to pick a degree and have an education with your parents or student loan counselor or an educator on, is this cost and is this degree, is there a market for this to where I can actually go earn enough to pay this debt back or pay for this education? Same with housing. Same with planning for retirement. We have to start thinking in a much longer time frame. And the reason that's important is because it requires much more discipline and sacrifice now than it ever has. And for those people that aren't practicing some of these things and they're not educating themselves, they are going to get left behind, and it's going to be a very rude awakening for them once they start hitting retirement age. And we're already starting to see that with some of the baby boomers and Gen Xers that are, hitting retirement as far as their quality of life. And I can tell you, I have had several friends who are baby boomers that have had to substantially downgrade their quality of life as they've approached retirement because they didn't do a good job with financial planning. And so that's what you have to think. That's why this is so important. And same thing for homeownership. When you buy a home, and that might mean not buying in the short term. In the short term right now, it's, in a lot of markets, it's actually cheaper to rent than it is to buy. But in the long term, home ownership should still be a goal.
Absolutely. Yeah, and then we could do a whole separate episode on just the reasons behind that. One of them just being appreciation and understanding the different types of appreciation when it comes to, forced appreciation, meaning doing some improvements to the home yourself, adding value in different ways, the tax benefits from owning versus renting. There's, a laundry list of benefits to home ownership. So despite people looking at a piece of paper and just comparing one number to the other, there definitely is a lot more that goes into it than just that. So I think you really hit the nail on the head, though, just saying that the biggest thing is just understanding today, might not be the right perfect time, but still having a game plan and educating yourself and putting your financial health in line today. So when that day does come in the future, you're ready and prepared to do so. And I think you had a really good suggestion a few months back. We were talking about just, improving your credit score and some of these other things we'll address here in a minute. But, let's just say, for example, you're considering renting versus owning. You can rent a house for $1,500 a month, or you can, buy a house, or you can expect to buy a house where your payment's going to be $2,000 a month. If you're going to decide to rent, to still put yourself in a position where you're training your financial literacy, and you're putting yourself, you're building up this muscle to as far as how to save and be prepared when that day does come. Even if your rent's only $1,500 a month right now, still assume that you have that same payment as if you do own, and put $2,000 a month towards your housing, $1,500 a month for your rent, and put that other $500 in a special dedicated account that you can set up for free with most banks. And then just start
Yeah.
building up that extra reserve, which can be a contribution towards your down payment. It could help cover other closing costs when you do decide to purchase a home. Inevitably, you're going to have, things that you're going to have to put money towards, fixing certain things, buying new furniture, whatever it may be. But just getting that mindset in place today where you're prepared and ready, and that when that day does come, that big jump in monthly payments isn't a slap in the face, because you've already trained yourself to account for that extra money and know that that's what it's going towards.
That's absolutely right. And I could not have said it better myself. You want to take on the identity of a homeowner. You want to start practicing those homeownership habits. And at the same time, hopefully, there will also be a little relief in the market, where if interest rates do come down, I think that can really go a long ways to providing some relief and making things a little bit more affordable. What else can you do other than do that? There are going to be some other things that you can do, and I wanted to share those.
Okay. And I would say not just what can you do, but also what you shouldn't do. I worry that a lot of
Right.
people, I'm sure you see this more than anybody, just since this is your day to day job, but just people that maybe decide to rent instead of buy right now. And all of a sudden, instead of putting that extra $500 a month into a special safe place, all of a sudden, you know what? Maybe I can't afford that new car payment. And then instead of getting closer to your goal, you're making a quick impulse decision, where now you're actually even further behind than you were in the first place. And it's going to be even more of a challenge to achieve home ownership.
That's exactly right. And you have to get the most out of every dollar you have. And so, in order to do that, there are things that you're going to need to do, but then there's also things that you're going to need to avoid. In America, in the United States, we always talk about everything like it's an income problem. What does our government do? They want to raise taxes. They want to create more income. Here's the reality. In the United States, we have the fourth highest household income in the world. There's only three countries that have a higher household income than us, and those countries are Scandinavian, and their tax rates are like 50 to 70%. And so in the US, yes, costs are higher, and a lot of these costs are the highest they've ever been, but it's still not an income problem. A lot of it is a personal finance and debt management problem. And what you were just saying is, a lot of times it means saying no. And that's the tough thing, that as Americans, we have a really difficult time because we've never been taught any of that. And financial literacy isn't taught in schools. And how our economy is set up, 70% of it is consumer driven based off of consumer spending. Our economy has grown the way that it has because of the consumer. Well, how do you do that? It's because the consumer is always spending and buying things. They're financing the new car. They're buying the things they probably shouldn't, the luxury goods, the things that they can't really afford. And that is what you have to say no to. So if you want to get the most out of every dollar, you have to say no to the new car, to financing the new car. An average new car payment in 2024 is over $750 a month.
Wow.
And this happens all the time in the mortgage world. I'm trying to pre-approve someone, and you got an $847 car payment. That's eating into your debt ratio. You got credit card debt. You got 4 credit cards that are maxed out. You have student loans that are going backwards. You have student loans that started at 50,000 and are up to 70,000 because you've been making the minimum payment. And that's a whole nother thing that people don't understand, is that when you do that on a student loan, these income-based loans, the payment might be low, but that's going back on the principal balance of the loan. So really, really educating yourself, saying no to the things that aren't going to bring you value, auto loans, credit card debts, being reasonable with student loans. And you have to remember, no one is looking out for you in our economy. Educators aren't looking out for you. They want you to take out student loan debt. People want you to go buy a new car and finance that. These companies want you to go spend all of your money. And when you take your hard-earned dollars and you go and give it away for consumption, it's really, really difficult to get ahead. So those are the things that you want to avoid. And by avoiding those things, that's going to protect your cash flow. Now, when it comes to credit cards and credit utilization, this is something that I love educating people on because they don't understand how important this is. There's 2 different types of credit utilization, and this is in reference to revolving accounts. So this would be in reference to credit cards. It would also be in reference to in-store charge cards. So if you have like a Costco Visa, or if you have like a Banana Republic or Old Navy or Best Buy charge card, Home Depot, Lowe's, it's in reference to these type of accounts. So you always want to keep the individual credit utilization under 30%. Most people think that, my limit's 10,000. I'm going to go, that means that I can go borrow 10,000 and I should. Well, no, that's wrong. Your limit might be 10,000, but you want to keep that balance at 30% or low. So if your limit's 10,000, keep that balance below 3,000. If you go over that, that's going to start to negatively impact your score. And this is way more important than credit inquiries, just about anything else on your credit other than making timely payments. Making your payments on time is number 1. How you manage your revolving credit is number 2. And then the other thing, though, is your global credit utilization. So you want to look at all of your accounts together. You might have 2 or 3 credit cards. And let's just say that you have 3 credit cards. Each one has a $10,000 limit. You want to keep that global utilization under 30% as well. And ideally, if you can keep it under 10%, that's going to put you in the best position possible to really maximize your credit score. Make your payments on time. You should never have any late payments when it comes to credit. You want to make sure that your credit is going to be in a great spot, so when you do need it and when you are ready to purchase, you're ready to go. You're not having to scramble. One thing that I see a lot of people, a mistake that they make, is they go find the home first and then they want to get qualified, not realizing that they need to, that they're not putting themselves in the best position because they haven't been managing their credit cards lately. So their credit score is lower. And that means that they're going to get less favorable financing terms, which means their payment's going to be higher. It might even mean they have to put more down. So you want to take these steps now, maximizing your credit score, keeping your credit balances low, keeping your credit utilization under 10%, not having any late payments. You also want to build out an emergency fund, like you were saying earlier, where you have at least 6 months. You can use that for whatever, unknown expenses. If there is an emergency, if you have a surplus, you can apply that to your housing fund. You want to protect your cash flow. That's what all of this comes down to. And if you're able to win in these other areas of personal finance and cash flow and debt management, if you're able to really win these other areas, then it's going to put less of, even though affordability right now is higher and or it's lower, meaning it's more costly. If you're winning in these other areas, you're going to be able to do a little bit more than you would otherwise.
Really good advice. The only other don't that I would add to that is don't co-sign on anybody else's debt. We didn't mention that one either, but if you have a sibling, somebody else in your family, a good best friend, somebody that just is requesting that you help them out by co-signing on a loan for them, car loan or whatever it may be, don't do that. And if you do, understand that that is, even though it's not your debt, you're still in a way responsible, to also pay that if they don't. And that's going to be affecting this exact same stuff Ben's talking about, your credit
Oh, I'm
utilization,
so
all this
glad you
stuff.
said that. I'm so glad you said that because even though it's not your debt, guess what? It is your debt.
Mm-hmm.
It is your debt. And that's a mistake that I've made personally where I have co-signed even knowing I should not do it and I still did it and it's still costing me to this day. And there's two reasons you should never co-sign. When someone comes to you and asks you to co-sign on can't afford, I need help buying this truck and I need you to co-sign, it means one of two things. Number one, they either don't make enough or they don't have a job to actually repay the debt. So would you want to go and co-sign for someone who literally does not have the financial means to pay it back? I mean, does that sound like a good idea?
No.
No.
Yeah, definitely not.
So that's option one. Option two means that they have a documented pattern of behavior of not paying their bills on time. That's the other reason someone would need to co-sign. So either they don't make enough to qualify, or they don't qualify because they don't make their payments on time. So you should never co-sign. The one exception to that I have is if it's an immediate family relationship where you are a parent and you're trying to help your kid qualify for maybe a mortgage, for example, to where they can start get in the game of home ownership. They understand their risks and you're willing to step in if needed and take over control of the asset and pay the debt, or vice versa. That's really the only time that I would recommend it. I would never co-sign on a depreciating asset or a credit card or anything else.
Yep, I agree. Guys, especially if you're a first time home buyer, you're just, getting into this and you have aspirations to, be a homeowner, but just are a little bit overwhelmed, especially in this current climate with how challenging it is, as we've been talking about today. One really good piece of advice I have, even if it's not going to be for a year or two, still go connect with a lender like Ben and just talk through not just, the cost of the home and what the interest rate is and what that kind of ballpark monthly payment is going to be, but really understand and go a little bit deeper into this with him to understand these other costs, the taxes, the insurance, all these different other expenses that if you add them all up are another significant amount of money that you have to be accounting for and budgeting to be, part of this higher monthly payment when you do decide to purchase a home. Just understanding that it's not just, one number here, one number there. There's quite a few different moving pieces in all of this. And I think that's just another example of being educated early on in the process. So you're not caught off guard when you do find that dream home in a year from now and you think everything's good. And then you're like, oh my God, wait a minute. What are all these other things that are, factoring into what I can afford? And I thought I could afford a $500,000 house. Now it's showing I can only afford a $375,000 home. There's a lot of just ability to avoid those curveballs or those, kind of left field challenges if you're a little bit more upfront with this process.
Yeah, and what you're talking about is planning, and that is something that most people don't do well enough, and you need to have a plan. And when you talk to a lender in advance, even if it's 6 months out, a year out, or 2 years out, it gives you the ability to start to put a plan together. You might have an auto loan that has a monthly payment that's $800 a month, but it might have a balance that's, $5,000 or less. And if you can pay that off over the next 6 months, well, that would radically increase your purchasing power. The average person is not going to know that. You also might be eligible for certain programs based on your income. One thing that's great is that as expensive as things have gotten, some of these income limits for affordable housing, at least here in Denver, have really gone up. So we can get people into affordable housing loans all the way up to 165,000, which is significant. So most people, may be eligible for down payment assistance. One of the programs that we work with Chaffa, they have a new program called First Generation, where if you have never owned a home, either applicant, and if their parents have never owned a home, they will give you $25,000 in down payment assistance, regardless of the sales price. So you could go find something for $300,000 and get down payment assistance of $25,000. Normally you would get 4%. So in a normal situation, if it was 300,000, you'd get 12,000. But with this program, if you've never owned a home, you can get up to 25,000. So you're not going to know that you're eligible for this stuff unless you actually talk to someone. But big picture, you want to be able to make an informed financial decision on a based off of your financial profile and the facts. And you want to know what those are and put a plan together so you can execute that next 6 months, the next year, 2 years, whatever it is.
Yeah, that's great, man. You guys, I think kind of froze on me, Ben. Can you hear me?
Yes. Okay.
I'll edit
And then other than that, I think this is also a really good time to talk about financial goals. And as you're planning, you want to start thinking about how much can I afford? How much do I want to come into closing with? And start having that conversation with yourself. What are some possible opportunity costs? I would also recommend at that point, getting yourself set up on a search so you can start to familiarize yourself with the market, start looking at homes online, starting to be able to identify homes that fit your criteria, both from a sales price perspective, from an area. And you will start to learn once you start to take these steps. What you're really doing is you're just educating yourself, not just in the mortgage world, but also in the real estate world as well. And that is how you empower yourself and make an informed decision. Do you want to work with professionals? Absolutely. You want to work with a mortgage professional and a real estate professional, but you also do want to take some accountability and empower yourself by learning some of this stuff so you can make better decisions. Your mortgage and real estate professionals are there as a guide. They're going to, provide a level of service to you, but you're the one that is signing on that line that's dotted. You're the one that's going to be making the payments. And so you want to make sure that you're informed, that you're confident, that you're doing what is in, your family's best interest.
Love it. And those are pretty minimal time commitments, getting set up on home searches, spending, 10, 15 minutes a day or a couple times a week, just kind of reviewing what matches are out there to your home search, just those little, pretty minimal tasks that you're assigning yourself, over a period of time could change, a good buy into a great buy, or prevent you from buying a home that maybe really was not what you should have bought. And I mean, it could equate to thousands, if not even 100,000 or more of dollars of savings just with making a better decision when you do get to that point. So very, very highly recommend that for sure.
How much does it cost to get set up on a home search with a real estate professional? $0.
It's pretty pricey these days. Yeah, I think the going rate right now is Zippo. So
how much does it cost to talk with a lender and have your credit pulled? $0. There's no cost. What are the risks? There is no risk. No cost, no risk. Go have the consultation, have the analysis.
And nowadays, you guys, you don't have to do this in person. You can do this over a Zoom call if you need to. It doesn't have to be a big, take a day off of work and go in and visit Ben. There's much easier ways nowadays to achieve doing these first initial steps. So
you're saying that for the Gen Zers, aren't you?
I'm speaking to you guys, Gen Zers. There's also probably a Starbucks nearby that you can meet Ben at if that's more appropriate for you.
On that note right there, it's funny because older generations always want to come into the office and meet me face to face. And I'll always tell my assistant, the whole point of that is they just kind of wanted to come in to meet me and shake my hand. As if that has anything to do with the fact that I'm shaking your hand, the fact that we did that, now you're going to be able to approve me.
Mm-hmm. It's awesome. Hey guys, before we close out this episode, I would just like to remind you that this episode today, episode 40 on the Pursuit of Progress podcast, is brought to you by Roadrunner Property Care. If you're looking to turn your home into a short-term vacation rental, look no further than Roadrunner Property Care. Let their team of experts take the stress off of your plate and put more dollars in your pocket. Contact them today at www.roadrunnertucson.com. And if you guys are enjoying the show, just a friendly reminder, make sure you guys hit that subscribe button if you're watching us on YouTube. And if you're on Spotify or Apple, make sure you guys follow the show and do us a solid. Give us a 5-star rating or a thumbs up. That really helps us push out the episode to more people and hopefully affect other people's decision-making as well to do a little bit better job themselves with education and just being prepared for when that day comes. Ben, before Before we close this one out, do you have anything else you'd like to say before we take out?
There are certain books that I like to go back and reread, and so I was going through my notes of a Stoic book called "The Obstacle Is the Way," written by Ryan Holiday. He's an author that's really focused on Stoicism, and this Marcus Aurelius, one of the first emperors of Rome, is kind of the subject of this book, and this is what he says: the obstacle in the path becomes the path. Never forget, within every obstacle is an opportunity to improve our condition. Don't wish it were easier, wish you were better. And the reason I just wanted to bring that up is because this housing market, this real estate market, this mortgage market has been challenging this last couple of years. And maybe you are someone that has wanted to purchase, and maybe you are one of the 90% that thinks that the American dream is dead or it's unachievable. And I just want to let you know that it is achievable. Don't give up, and allow yourself to become more skilled. Challenge yourself, learn some of these things that we're talking about, because things will get easier. When you look at some historical charts, it is a difficult time right now as far as affordability, but this is not the first time that this has happened. So things will ease up, things will get better, and you can still achieve your dreams. But in the meantime, work on your skills, grow as a person. I mean, that's what we're here for, right? We are the pursuit of progress. So pursue progress in every area of your life.
Mic drop. Love that, man. That is very well said, dude. All right,
Dropping
guys.
that
Well,
mic.
hope you guys got some value out of this one. I think Ben, obviously, I could hear it in his voice today that he has a ton of value that not only is very beneficial to anyone that's wanting to get into the real estate game, but I think also just really motivating that even in a very challenging time like we're in right now, there's still opportunities out there. And the ones that I've always seen to be the most successful in life are people that see these lulls, these kind of lower activity times in our lives, using those opportunities to again educate and just be more prepared, taking
Yeah.
advantage of the extra time and resources and just doing more now, so when that day does come, you're way above the 90% of people that are just sitting right now being pessimistic, not thinking that it's ever going to happen, just basically using this as an excuse to just slack off and just not put any energy or any time and effort into getting better, even in these times that maybe it's not the most opportune for you, but it could be in very close, a few months from now, it could be a great time. So put the reps in today so you guys are ready when that day comes.
That's right. That's right. Double mic drop. All right. Well, with that said, we are wrapping up episode 40. I hope everyone has a great week, and we will see you next time on the Pursuit of Progress podcast. Thanks, everybody.
See you guys.